Welcome to the Deep Dive. Today we're digging into Chewy's Q2 fiscal 2025 earnings. That's ticker CHWY. The call was back on September 10th.
And it was, well, a real head-scratcher of a quarter, wasn't it?
Absolutely. I mean, you look at the numbers, and Chewy actually delivered on several key metrics. Revenue beat, margins expanded.
Yeah, strong operational results on paper.
But then the market just hammered the stock down, what was it, almost 17% on the day?
16.6%, yeah. A brutal reaction.
So our job today is to figure out that disconnect. What happened? We need to go past the headlines and understand the strategy, the context.
And why investors reacted so negatively despite the beats. Why this feeling of good, but just not good enough?
Okay, let's start with the results themselves, the positives. Lay those out for us.
Sure. So net sales came in at $3.104 billion. That's up 8.6% year over year.
And that beat their own guidance and what the street was expecting, right?
Correct. Solid beat on the top line. And profitability looked good, too. Non-GAAP EPS, $0.33.
That was in line with expectations, but up 9 cents from last year. Decent increase.
Exactly. And the margins were arguably the highlight. A gross margin expanded 90 basis points year over year, hitting 30.4%.
30.4, wow.
Yeah. And adjusted EBITDA was strong too, $183.3 million. That's a 5.9% margin, so 80 basis points of expansion there as well.
Okay, so sales beat, EPS in line, but up, margins expanding nicely. Sounds like a recipe for a stock pop, usually?
You'd think so. But like you said, the market reaction was severe.
So here's the core tension. They even raised their full-year sales outlook, and yet the stock just cratered. What was the specific driver of that negativity?
It really boils down to investor focus shifting. Post-pandemic, just growing isn't enough, and even margin expansion isn't the whole story if it comes at the expense of, well, future growth signals.
Okay.
The hypersensitivity was laser-focused on one thing, the pace of customer growth. Active customer additions. The market essentially asked, where are the new customers, and didn't like the answer.
All right, let's get into that.
Yeah.
Because Autoship, their subscription engine, that still looks incredibly strong.
Oh, absolutely. Autoship is the core. It hit $2.577 billion in the quarter.
Which is what percentage of total sales now?
A new record, 83%. 83.
Wow.
And crucially, those Autoship sales grew 15% year over year.
15%. So that's growing way faster than the overall company revenue growth of 8.6%.
Exactly. It shows the existing customer base is incredibly sticky, they're spending more, they're locked in. That recurring revenue is gold.
But then we get to the number that seemed to cause all the pain.
Yeah.
Active customers.
Yep, that's the one. It came in at 20.906 million.
Which sounds like a lot, but the growth rate.
Only 4.5% year over year growth. And that slow cadence of adding new customers, that's what the street flagged.
That was the disappointment.
That was the big disappointment. You know, pet household formation has definitely slowed from the pandemic peaks. Acquiring new customers is tougher, more expensive now.
So that 4.5% growth just signaled a bigger slowdown than investors were prepared for.
Precisely. It overshadowed the other metrics in the market size.
But hold on. If Autoship is 83% of sales, and those customers are clearly sticking around and spending more net sales per active customer, and NSPAC was up 4.6% to $591.
Right. Also a strong number. Shows share of wallet gains.
So if the existing customers are getting more valuable, why such panic over fewer new ones coming in the door right now? Doesn't quality trump quantity here?
Logically, yes. If you're focused on long-term customer lifetime value, CLV, it absolutely should. Better, stickier customers spending more is fantastic.
But the market's not thinking long-term right now.
The market, or at least the part driving the price action that day, was focused on the short-term sequential ads. It punished the perceived slowdown there. Management tried to push back by highlighting the drivers of the margin strength, showing it wasn't just, price hikes.
Okay, so let's talk about that margin expansion, that 90 basis points on the gross margin. Where did that come from specifically?
They called out two main things. First, their sponsored ads business is growing rapidly. That's very high-margin stuff.
All right, pure profit almost.
Pretty much. Second, a favorable mix shift. People are buying more premium things, consumables, and especially their health and pharmacy products, which are growing fast.
Interesting. What about hard goods? Like toys, beds, that sort of thing?
Surprisingly strong, too. Grew over 15% year over year. And they made a point of saying it was driven mostly by volume, not just price increases. Suggests they're taking share there, too.
Okay, so operationally strong, taking share. Which brings us to the guidance and the strategy. This seems to be where things really diverge from what the market wanted.
Exactly, the investment trade-off. So they raised the full-year sales guidance, now looking for $12.5 billion to $12.6 billion.
That's the positive signal. Confidence in demand.
Yes, but, and this is the crucial part, they kept the full-year adjusted EBITDA margin outlook the same, maintained at 5.4% to 5.7%.
Ah, so higher sales, but the same profit margin percentage, meaning the extra profit from the sales beat isn't dropping straight to the bottom line.
Precisely. Management basically said, look, we outperformed operationally, but we're choosing to reinvest that beat. They used the phrase on the offense, prioritizing market share gains over maximizing the immediate EPS flow-through.
On the offense. Or is that maybe covering for higher costs needed to fight that customer acquisition slowdown we talked about? Higher marketing spend, maybe?
Well, it's likely a bit of both, realistically.
Yeah.
But the direction of the investment seems genuinely offensive, aimed at attracting and retaining really high-value customers. You just have to look at where the focus is.
Okay, like what?
Like the Chewy Plus paid membership program, that's a huge priority.
Why, the subscription tier? How's that doing?
They said it's ramping fast, strong product market fit. By the end of July, about 3% of their total monthly sales were coming just from Chewy Plus members.
Okay, 3%. And the goal?
Mid-single-digit percentage of net sales by the end of this fiscal year.
And these members are more valuable, presumably.
Definitely. They highlighted that Chewy Plus members buy more often, they attach more products to their orders, they use the app more. Leads to a much faster ramp in that NSPAC metric we discussed.
But you mentioned investment. Does this program cost money up front? They said something about margin rate dilution.
Yes, good catch. It's temporarily dilutive to the gross margin rate. Think about it. You offer perks, maybe some initial discounts. There are platform costs to onboard these members. So the percentage margin looks a bit lower initially during this ramp-up phase.
Okay.
However, they expect the program to be gross profit dollar accretive this fiscal year. Meaning, even with the lower rate, they're making more actual dollars from these members right away because they spend so much more. It's an investment, pure and simple.
An investment in higher lifetime value. Got it.
Exactly, which leads perfectly into the other big investment, the Get Real Fresh Food initiative.
Ah, yes, the move into fresh and frozen. That feels like a really significant long-term play.
It absolutely is. That fresh frozen pet food market is booming. They estimate the TAM total addressable market could be $8 billion to $12 billion in the next few years.
Huge potential.
And Get Real is their own private brand. Minimally processed, fresh dog food. Early signs are apparently very strong.
And the customers buying it are the existing Chewy users.
This is key. They said the early customer quality is phenomenal. Full meal, Get Real customers are projected to spend over $2,500 a year with Chewy.
Wow, $2,500. That's a massive NSPAC number.
It really is. And maybe even more importantly, they said 30% of the initial Get Real customers are completely new to Chewy.
Net new customers spending $2,500 a year. That completely changes the math on customer acquisition cost and value, doesn't it?
It potentially flips the script entirely. They're attracting the absolute highest value cohort, and they've apparently built out capacity for this through 2028, all while staying within their usual capital expenditure range of 1.5% to 2% of sales.
Okay, but these big investments, Chewy plus Cole, Get Real, building capacity, they must show up somewhere on the cost side now, right? Let's look at SG&A expenses. Selling, general and administrative, that actually deleveraged year over year temporarily. Why?
Good question. It seems counterintuitive if they're focused on efficiency, but they explained it was mainly due to two temporary things.
Okay.
First, the 6-month ramp-up phase of their big new fulfillment center in Houston. When you open a new FEC, you have upfront costs, hiring, training, getting inventory in place before it's running at full speed and efficiency.
Yeah.
That hits SG&A.
Makes sense. Inefficiency during ramp-up. What was the second factor?
They proactively pulled forward some inbound inventory processing costs, basically stocking up early, partly to mitigate potential tariff impacts down the road, and partly just to be really well stocked for the holiday season and grab share if competitors stumble.
So temporary operational factors.
Huh.
They expect SG&A leverage to return.
Yes, they were clear on that. Expect leverage, meaning SG&A growing slower than sales, to return in the second half of the fiscal year as Houston ramps up and those inventory costs normalize.
Okay, stepping back then. The big picture. The pet industry itself is growing. What, low to mid-single digits?
Pet household formation is kind of flat to slightly up, so the overall industry growth is pretty modest right now.
But Chewy's projecting 7% to 8% growth for the year.
Right, so they're definitely gaining market share. That's undeniable.
And management sees the second half, with potential tariffs hitting competitors, as a chance to lean in and accelerate that share gain.
That seems to be the bet. Leverage their scale, their inventory position, and maybe absorb costs that smaller players can't, allowing them to press their advantage.
So the whole valuation debate really comes down to this. Do you believe in the long-term value creation from Chewy plus lack from Get Real from these high-end S-Pack customers?
Or are you more focused on the immediate slowdown in the number of new customers being added sequentially?
It's a classic growth versus value versus quality argument, really.
Exactly. The market on that earnings day voted very clearly for worrying about the sequential ads.
Okay, so looking ahead, what are the key things you or an investor should be watching over the next quarter or two to see if Chewy's strategic bet is actually paying off? What are the catalysts?
I'd watch three main things super closely. First, more data on Chewy Plus Trust. They need to keep showing adoption growth, but also, crucially, show strong retention and high attach rates for products. Prove the model works.
Okay, Chewy Plus metrics. What else?
Second, just hitting their numbers. Deliver against the Q3 guidance they gave. That's $3.07 billion to $3.10 billion in net sales, and EPS between $0.288 and $0.33. If they hit that, it validates the underlying margin strength.
Makes sense. Execution is key. And third,
continued progress in those high-value, high-margin areas, health and pharmacy and the advertising business, show that those profit engines are still firing. Oh, and maybe an update on the permanent CFO search. Leadership stability always helps.
Right, good point. They have an interim person now. Okay, makes sense.
All right, and now we get to put on our disclaimer hat very firmly. This next bit is absolutely not financial advice.
Definitely not. Purely educational, maybe a little bit entertaining. We're just exploring ideas here.
Exactly. We're going to pitch an outrageous but maybe plausible trade idea just based on the sheer drama of that post-earnings reaction.
Okay, let's hear it. Given the facts, 16.6% drop, sales guide raised, 83% recurring revenue from Autoship. It does feel like an overreaction based purely on sequential customer ads.
The outrageous thesis is this. You bet long on the idea that big institutional money sees this volatility as a buying opportunity.
Okay, why?
Because they believe in the long-term story, the inevitability of that Autoship flywheel, the huge potential CLV uplift from QE Plus members, and especially those $2,500 a year, Get Real customers.
So the idea is that the short-term noise about customer ads will fade.
Exactly. The thesis is that the long-term structural defensibility and profitability driven by customer quality will eventually outweigh the short-term fixation on customer quantity. You're betting that this extreme sell-off created an entry point for those focused further out. Maybe selling some out-of-the-money puts or just a straight long position, looking out towards maybe the Q4 results.
A bet on rationality returning, basically, and on the power of that high-value customer cohort scaling up.
Pretty much. A bet that the market overreacted emotionally and will eventually recognize the underlying strength, leading to a snapback. Again, purely hypothetical, not advice.
Understood. So let's recap the deep dive then. Chewy is, by most operational metrics, executing really well. Margins are up, Autoship is dominant, they're investing in high-value areas.
But the market punished them, and punished them hard. Why? Because they chose to reinvest their outperformance for long-term share gain, particularly in attracting those high CLV customers via Chewy Plus and Get Real, rather than letting profits flow straight through to meet short-term EPS expectations.
And because that headline, active customer growth number, slowed down more than expected.
Right. Which leads us to the final provocative thought for you, the listener, to chew on.
Go for it.
If Chewy succeeds with Get Real, and they really do scale up a cohort of customers spending $2,500 plus a year, customers who are stickier and more profitable, does that temporary slowdown in the total number of active customers even matter that much to the long-term value of the business?
That's the multi-billion-dollar question, isn't it? Something to definitely think about. Thanks for tuning into this deep dive.